Golden parachutes are lucrative severance packages often found in executive contracts in the event the executive is terminated as a result of a merger or takeover.
Is it something what's almost like a standard and it's expected by key executives to have as part of their compensation package?
Now, in a hostile takeover, what you do is you ignore the board altogether. You go around the board and you go straight to the company's real owners, who are, of course, the company's shareholders.
Instead of fighting with petroleum companies, I'm sitting around the table with them.
Yeah, at the right price. I'd love to see that happen at the right price.
On the 2nd of December, Gevo filed an 8K form to the SEC, a change of control severance plan, also known as Section 280G. The plan was approved and adopted by the Compensation Committee of Gevo's Board of Directors. The severance plan includes certain of the company's executive officers and senior management. The plan regards Lynn Small, Chief Financial Officer, Tim Cesarek, Chief Commercial Officer, and Paul Bloom, Chief Carbon and Innovation Officer. If a change of control occurs, these three individuals will receive monthly salary continuation for 12 months following the date of termination. They will also be paid target annual bonuses for the fiscal year during which year the termination occurs. And here's an explanation of the purpose of the plan.
The plan is intended to ensure that the company will have the continued dedication of certain key employees of the company, notwithstanding the possibility or occurrence of a change in control, as defined below, to diminish the distraction of such employees that may occur by virtue of the personal uncertainties and risks created by a potential or actual change in control, to encourage such employees' full attention and dedication to the company currently and in the event of any potential or actual change in control, and to provide such employees with compensation and benefits arrangements upon a change in control that are competitive with those of other peer corporations.
And the change of control is defined as any of the following:
the sale, lease, transfer, conveyance or other disposition, other than by way of merger or consolidation, but not including any underwritten public offering registered under the Securities Act of 1933, public offering, or any offering of securities under Rule 144A promulgated under the Securities Act of 1933, Rule 144A offering, in one or a series of related transactions of all or substantially all of the assets of the company taken as a whole to any person or group of persons acting together, each group other than any of the company's wholly owned subsidiaries or any company employee pension or benefits plan. The consummation of any transactions, including any stock or asset purchase, sale, acquisition, disposition, merger, consolidation or reorganization, but not including any public offering or Rule 144A offering, the result of which is that any person or group, other than any of the company's wholly owned subsidiaries, any underwriter temporarily holding securities pursuant to a public offering or any company employee pension or benefits plan, becomes the beneficial owners of more than 40% of the aggregate voting power of all classes of stock of the company having the right to elect directors under ordinary circumstances.
I don't even know what that means.
No one knows what it means, but it's provocative.
So how do we as investors interpret all this? In this video, I will approach this subject from different perspectives. I will present 3 theories with possible explanations to why Gevo has set up this arrangement for its executives, without being too conspiratorial. A change of control agreement is necessary in following situations: when the new controller wants to fire the existing management, or if the existing management voluntarily wants to leave when the new controller takes over. But the agreement can also be used as an incentive for the new controller to keep the existing management. A change of control agreement is commonly referred to as the golden parachute payment, and are of great importance in conjunction with mergers and acquisitions.
Golden parachutes are lucrative severance packages often found in executive contracts in the event the executive is terminated as a result of a merger or takeover. These are usually contracts with top executives and can be used by a firm to discourage an unwanted takeover attempt. For that reason, they are often referred to as poison pills. Golden parachutes are named as such because they provide a soft landing filled with money for employees at top levels who lose their jobs. And in addition to large bonuses and stock compensation, golden parachutes may include ongoing insurance and other retirement benefits.
So my first theory is that this is just normal practice, and here's why.
Good afternoon and welcome to today's webinar on mergers and acquisitions and retaining key talent. For companies with a deal horizon, with a deal on the horizon, and even for those where a deal is perhaps just a future possibility, understanding change in control provisions is a must. I'm joined today by two experts in this field, Margaret Black and Dan Wetzel, both managing directors in Pearl Meyer's Los Angeles office. They have decades of experience advising companies on critical legal and tax issues related to change in control contracts. So, Margaret, may I just ask a follow-up question here? You said, if I heard you correctly, between 70 and 75% of the companies already have change in control agreements, even if there is no deal on the horizon. Is this basically for public companies, or do you see the same in private equity-owned companies or in private companies? So that's one question. And then the other question is, if there's no deal on the horizon, but 70 to 75% of the companies have it already, is it something what's almost like a standard and it's expected by key executives to have as part of their compensation package?
Well, I was thinking that, from the standpoint of public companies, it is pretty much the norm to have a change in control agreement for senior executives, and it's nearly universal on the equity, right? Which is a broader participant group.
Absolutely. That's why I asked the question, because, in all the companies I'm on the board of and where I was CEO, it's to be expected.
So, as explained, golden parachutes are considered standard in long-term agreements, as they provide substantial leverage. My next theory is that Gevo will use this as protection against a hostile takeover. Let's dive deeper into this.
Hi, it's Paddy Hirsch at Marketplace. So you want to buy a public company? Well, the key to your success or failure is going to be the company's board of directors. Now, the board of directors are a bunch of men and women who sit around and make all the big decisions about what a company is going to do, like, is it going to buy another company or is it going to be bought by you? So if more than 50% of the board vote in favor of your takeover offer, you're in great shape. You can buy the company. But if more than 50% of the board vote against your takeover offer, well, it means you're going to have to use another strategy. And you may decide to go hostile. Now, in a hostile takeover, what you do is you ignore the board altogether. You go around the board and you go straight to the company's real owners, who are, of course, the company's shareholders. Now, in a hostile takeover, you've got two possible options. The first thing you can do is to launch what's called a tender offer. And in a tender offer, what you do is you make an announcement of your intention to buy shares of the company at a certain price. That's usually way more than what it's trading at in the market at any point. The reason for that is because you want to get as many of those shares as possible, because the more shares that you have, the bigger stake in the company you have, and the bigger your stake in the company, the more control you have over what the company might do, like sell itself to you. The second option you have in a hostile takeover is to use what's called a proxy fight. And in a proxy fight, what you want to do is try and change the mind of all of these shareholders, right? You're less interested in the stock price now. What you want to do is to launch a big publicity campaign to try and convince these shareholders to vote out all the members of the board that are opposing you and vote in members of the board who like the idea of your takeover and would be quite happy to sell the company to you. Now, the problem is there are risks in both of these cases, all right? They can be extraordinarily expensive. You could spend a lot of money buying shares or a lot of money on a big expensive publicity campaign, and you might end up not getting the company. And that, of course, would leave you very badly needing a drink.
Here's how golden parachutes can serve as protection against hostile takeovers.
They are often referred to as poison pills.
Golden parachutes were created for two specific reasons. One is to ensure that the management's interests are aligned with the shareholders. Now, the second is, protection against corporate raiders. Well, during the junk bond era of the 1980s, corporate raiders with little equity and a lot of debt could walk up to a billion-dollar enterprise and buy it up, then take the business apart to pay down debt and walk away with any of the profits. In reaction to some short-sighted raiders, companies implemented lucrative golden agreements with the C-suite to make it incredibly costly for an acquisition to go through. This was very relevant back then. It was very important because it was an anti-takeover defense. So say, for example, you are the CEO of a company that has a $500 million market cap. You're not a billion-dollar enterprise, but you're a relatively big company. But say, for example, the aggregate golden parachutes for the 5 executives, the C-suite level of the company, would sum up to about probably $100 million liability. Well, the acquirer would have to look at that, and he's obligated to, price that parachute in and price that deferred compensation in, right? So the moment that he acquires the company, the payout, the compensation package is released. And so that $100 million walks out the door. For a $500 million company, and maybe the numbers are a little bit overstated, but think about it. For that $500 million company, that's a lot of money. That's 20% of the company's market cap. So it's a defense. It really deters a lot of interest in that company, because they know, the rater knows that in a scenario where they do pursue that company, they're going to have to pay out those executives, pay off them using the golden parachute, and therefore they're going to have to acquire the company at a higher premium, right? So maybe we'll have to pay $800 million rather than $700 million to really get that $200 million premium, because $100 million of that is going to be going to the executives alone. Right, so it was an anti-takeover defense.
At first glimpse, this reason may have seemed more relevant in the past, but considering the current bear market and worrying market conditions, there's once again perfect reason for a company to set up this sort of arrangement as protection against corporate raiders and hostile takeovers. Especially for a growth company like Gevo, whose market cap is now trading below book value. The most recent example of a hostile takeover is, of course, Elon Musk's acquisition of Twitter, and he used a tender offer as approach.
In a tender offer, what you do is you make an announcement of your intention to buy shares of the company at a certain price.
Once he had gained control of the company, he fired the entire board and a great number of employees. This is also a potential outcome if a hostile takeover were to happen to Gevo. Coinbase is another Nasdaq-listed company facing great risk of a hostile takeover, since their stock price has plunged more than 80% since the IPO in 2021. And the appetite for mergers and acquisitions is expected to increase even more as we approach 2023. BlackRock predicts we're facing a recession unlike any other, and that we have to handle these challenges in a very different way than we've done before. So we might be entering a new era of hostile takeovers and corporate raids. My third and last theory is that Gevo is planning a merger. We're well aware of Gevo's financial situation. They need to build a bunch of net zero plants in order to fulfill all their offtake agreements. And one way of securing a strong balance sheet would be to merge with a much bigger player, one that shares Gevo's net zero vision. This would explain the timing for this change of control agreement to be in place for the C-suite.
Well, consider the decision that management faces when asked to decide on a takeover offer that would result in their firing or demotion. So if you are the CEO of a company, and say, for example, you're making $5 million a year, and all of a sudden, your company receives an offer, and you know that if you accept this offer and merge the company with the existing operations of that acquirer, you'll probably lose your job because, you don't need to run that company anymore. The acquirer will, right? So they'll push you out. Well, is it really in your self-interest to give up your job, this very, very lucrative job, pays you $5 million a year, if you're not going to receive anything back? No. But with golden parachutes, if you know that you're going to lose your job, but you know that this golden parachute is going to be triggered and it's going to pay you quite a large sum of money up front, then you have a larger incentive to negotiate with that party and therefore, do more deals. Right? And that's really the most important point, the reason why golden parachutes exist.
Everybody's on the same page that we need to have carbon reductions. We need to see that happening. So we see, instead of fighting with petroleum companies, I'm sitting around the table with them. We are sitting around the table with them.
If Gevo was planning for a merger, I regard these 3 petroleum giants to be the prime suspects. Earlier in 2022, Chevron completed the acquisition of Renewable Energy Group, a company specialized in producing renewable fuels that significantly lower greenhouse gases. Listen to what Mike Wirth, the CEO of Chevron, said in this interview back in January of 2022.
we've got a history of well-timed acquisitions over the years, and that's certainly part of our DNA. So we're always on the alert for value-creating transactions for our shareholders, but we don't need to do anything unless it's really a deal that is a good one.
So since this interview, Chevron has acquired 2 companies, Renewable Energy Group and Beyond 6. And both these companies operate in the space of renewable fuels. Another potential partner for Gevo to merge with is Shell. Shell has recently acquired several companies that produce renewable energy, from solar and wind power to EV chargers. And in November this year, Shell acquired the Southeast Asian waste oil recycling firm Eco Oils Group, which John Toshka, the president of Shell Aviation, refers as another step towards more sustainable aviation fuel. And then there's BP, which we know already is Gevo's sole customer for the RNG project. BP has also completed a number of acquisitions within the renewable energy space lately. BP is also aiming to take on a significant role in the SAF industry. They have teamed up with jet engine manufacturers Rolls-Royce and Pratt & Whitney to test their engines with SAF. And they have also signed a SAF supply agreement with DHL Express. So if Gevo is planning to merge with a bigger fish, I believe it's one of these 3. The big question is, would Gevo be willing to sell the company when their stock is trading at these extremely low levels?
Do you anticipate Gevo being acquired down the road?
Yeah, at the right price. I'd love to see that happen. At the right price. What's that price?
What kind of offer would they consider to be the right price? My personal opinion is that any deal under $5 billion to buy Gevo is an absolute bargain. But with today's stock price in mind, even $1 billion is more than double Gevo's current market cap. Would Gevo really be willing to throw their shareholders under the bus for a crappy offer just to secure the company's future? Well, my guess is that they probably would consider to vote in favor for a merger with a company like Chevron, BP, or Shell. But that's just what I think. What do you think? Why did Gevo file this change of control agreement at this point in time? Was it just standard procedure? Is it to serve as protection against raiders? Or do they anticipate a buyout? Please share your thoughts in the comment section below. If you appreciate my videos, please hit the like button and subscribe to my channel. I make these videos just to inform and entertain, and you should not consider them as any kind of financial advice. I hope I get an opportunity to release a new video soon, but until then, bye bye.